Hi, this is Scott from Beyond the Numbers and welcome to this week's blog. So this week we're doing strategy 4 on managing your debtors from my book Cash Flow Strategies for a Successful Business. So let's get started. So a few years ago I got a consulting job, and this business had a bit of a gap between changes of their financial directors, and so they wanted someone to just come and fill the gap, and because it was the year end so the new director could start fresh. And having a look at their financial reports, it showed they'd made a profit of over $200,000 for the year. However, when I ran their figures through my cash flow template, I noticed there were some major issues, and the first thing that stuck out was their accounts receivable, or their debtors. And I printed out their aged debtors and found out they had over $200,000 in their 90 days. So I started going through their debtors one by one, and I found a number of problems. So some of their customers had been sent out the invoices twice. And other issues, that people had been sent out invoices even though they didn't want the services or hadn't committed to buying the services. And so this means that they had overstayed their income, and so their income was a lot higher than what it should have been. Another problem I found was that some of the debtors had left the country, and so trying to recover the money was going to be near impossible. And so what happened was the large profit that this business thought they'd made was gone, just like that. And so what made the issue worse was that the management of the company had made decisions based on the large profit that they had made, and so they'd committed to projects, spending money. And this is an example of what happens when you don't monitor your debtors. Your accounts could be wrong, and you're making decisions that are based on poor information. Another consequence that comes out of not managing your debtors is paying too much tax. So in this situation, by overstating their income by $200,000, if the company tax rate was 30 cents on the dollar, then they would owe $60,000 in tax. And they're not going to receive that money. So if they pay that $60,000 in company tax, by the time and then they find out later that they're not going to receive that money, and so that's going to be a huge impact on their cash flow. So, and I've seen this a number of times over the years. So let's look at 3 strategies, simple strategies that you can start working on your debtors today. First thing is to regularly review your accounts receivable. So pick a day a week or a fortnight that you'll review your age receivables report or your debtors listing, and be consistent. So always review on the day that it falls. Second, set yourself a warning system or a measurement, or if you like dashboard reporting or a traffic light system. So one example would be if your debtor days are 30 days, so that means your debtor days need to be 1/12. So if you have let's say $1 million in turnover in sales for a year, divided by 12, you get 83,300. And so you want your debtor days to be, you want your aged receivable or your debtors to be under 83,000. So if it's under 83,000, then on your traffic light system you got green. Let's say between 83,000 and 100,000, then you got orange, and if it's over 100,000, it's red. That means you must take action immediately. Thirdly, review your system. Remember, when it comes to debtors, accounts receivable, prevention is always better than cure. So make sure that your system is solid, and secondly, make sure that it's always being followed. Now, one last little thing is that if there's something you don't like doing in your debtors, such as calling people up asking for money, then hire someone else to do it. So you're spending your time on stuff that's productive. Anyway, that's all for this week, and thanks for listening. If you haven't, you can download my book, 10 Cash Flow Strategies for Successful Business, at the link on your screen. Thank you very much.